All right, so let's talk about stress test results, which we saw coming up on Friday. But then one of the fund that came out winning in the result is Edelweiss midcap and small cap. And to talk more about this, I have with me Trideep Bhattacharya, CIO-Equities, Edelweiss Mutual Fund. Trideep, hi, good evening and welcome to the show. Thank you so much for taking your time out, and congratulations, because as per the result, your AMC has taken not more than 1 day. I mean, minimum amount of days, to liquidate your assets in the portfolio. But let's talk about the impact of this stress test first, and then we'll get into the nitty-gritties about how do you plan to liquidate and how is it possible for you to do it in such less days, be it 25% or 50%. But then talking about the overall impact of this particular stress test for an investor, or in terms of knowing the crisis situation operation that a fund manager or a AMC would be handling, what is the kind of message and impact do you think is going to an investor?
First of all, good evening. Thanks for inviting me to your popular show. I would say, and thanks for your kind words. I think overall, this is a step in the right direction made by the regulator by increasing the transparency and by providing additional disclosure to potential investors with regards to what one of the factors that they should consider, that on a rainy day, if liquidity were to be a significant event, then how much time will the fund manager or the house take to liquidate 50% of the holdings and 25% of the holdings? And the sharper end of the liquidity is the mid and small cap funds, and hence this stress test was done on mid and small cap funds. The relevance of this, I think one has to keep in mind that this is true for really extreme circumstances that a fund house or an investor will have to deal with such a situation. But like in many other studies, the way they should take home the message is there is a normal distribution. There are less number of days or X number of days which with a fund manager will take to liquidate their stocks. There are funds which are to the extreme right, which is probably like us. We would take probably a day or two to liquidate the entire holding. And on the other extreme, you have certain number of funds who will take north of 20 days to sort of, liquidate their funds. So I think the extremes is what we need to be mindful of, while the right side of the spectrum, which is the lesser number of days it takes, makes it better for the investor, makes it more convenient for him to invest. The ones particularly to the left brings with it the liquidity sort of risk along with the portfolio, which investors should be mindful of. So it's an additional risk factor that investors should be mindful of, not the only decision-making criteria. But yeah, I think it's a step in the right direction.
In your small cap fund, you're taking almost 3 days to liquidate 50% and 2 days to liquidate 25%. And in your mid cap fund, the number of days is 2 for 50 and 1 for 25%. I really want to understand how are you able to do it in such less days as compared to the other funds, same category funds who are obviously of a bigger AUM also, are giving a different type of returns. But then what is the kind of calculation and liquid or illiquid stock position in the portfolio of both of your funds?
Yeah. So I think the first thing has got to be the portfolio construction. I think the portfolio, while we construct the portfolio, we keep in mind that the liquidity of the stocks that we have, assuming actually tighter conditions, which is 20% participation, we can liquidate more than 90% of the portfolio in the course of a week. I mean, that's how we track it internally. And the portfolio construction, and this is taken care of right at the portfolio construction level. And hence the outcome is what you see, that 50% of the portfolio can be done in a matter of 2 days. I'm talking about the mid-cap portfolio here, and likewise for the small-cap fund. So the first spot or the first place where we internally take care of this is at the portfolio construction stage. Second, we monitor it on even before this regulation came through, we used to and we continue to monitor it on a monthly basis. So any deviations from this, we are very mindful of, particularly when we are running the portfolios on a day-on-day basis. Third, the investor concentration. The number of investors that we have in a particular fund, we make sure that the investor concentration is minimal. For example, our top client would be 1.5% of the portfolio. That gives adequate clearance for any investor who thinks about investing in the fund is that if, for instance, take the other side, if one investor were to hold 25% of the portfolio and he were to decide to liquidate, then the entire stress test could come to bear. So to make sure that we don't get into that situation, the top client concentration is also managed in a very regular way, in a very conscious way. And finally, I think I would say it's a function of the AUM. Our funds are right-sized for the category that we run, which is mid and small cap, and that makes us that makes us take those nimble-footed calls that we can go in and come out of stocks without creating any impact cost.
You sitting on any cash in both of these funds?
The final point that I would make, and thanks for bringing that out, that this is achieved, by the way, without holding significant cash. So the cash in the in both the funds is actually less than 3%, and we make it a point of our process that we don't hold cash in our portfolios. So not only we don't have cash, but also we are not hiding behind large cap stocks to get to this result. It's purely driven by portfolio construction and how carefully we choose the stocks in such a way that we get the adequate returns, but at the same time, we keep the liquidity in mind.
So, Trideep, now let's, deep dive in the portfolio construction part and specifically talking about small cap, because a general observation regarding the portfolio, composition or the strategies the fund managers are also picking up. It's been observed that the average PE for a small cap is anywhere between 18 to 48, okay? On an average, I'm talking about across small cap funds. And for a mid cap, it is somewhere around 21 to 60. So, what is the average PE condition of your small cap portfolio, and how are you taking all that under consideration? Because it also seems that the fund managers have not, taken stock of expensive valuation, and it's not something that's really bothering them, but then, where they can see a better growth, or maybe some are taking refuge in, having a value-based strategy. So what's your composition like, and what's the average PE that you are holding?
Yeah. So for instance, for both mid and small cap funds, particularly the small cap fund, the average PE multiple for the portfolio is 26.5 times. So that is well on the lower side of the range that you mentioned of the mutual fund industry that we have in mind. In fact, the other way to think about this is how much we are paying for versus the growth that we get. So a PEG ratio, which is price per unit of growth, is a good way to benchmark different funds. And that level also, we operate between 1 to 1.2, which means that overall, we are not in the cheapest of the markets. The markets are probably fair value to slightly expensive. But still, we can operate at levels which can give us return in sync with the earnings growth of the companies, or slightly lesser than that, rather than trying to bank on valuation re-rating. So we've been particularly mindful that the stocks that we bet on from at the portfolio construction side are on the lower side, as you can see in the outcome. And also, we balance the price value equation by achieving a price PEG ratio of somewhere between 1.1 to 1.2. That's the holy grail of portfolio construction, and that's what we look to achieve. And fortunately, that has come out that way.
You tilt towards having a lot of illiquid counters in your small cap and mid caps?
Pardon me, can you repeat that question, please?
Towards having a good amount of exposure in illiquid mid caps and small caps?
So I think that's the other thing that we avoid. That we in our target return computation before we take a bet, we build in the liquidity premium in such a way that steers the team away from taking bets on the illiquid counters, and that's the reason why the illiquid stocks in our portfolio is kind of fairly limited.
Sure. Talking about small cap, okay, we can see a lot of reports saying that, they have almost corrected by 12%, but then the froth is still intact because, it's still down. Even if it's down, if you talk about small cap indices, almost to December levels, it is still way above what it was a year back. So, do you think this being frothy, or the kind of terms that we are putting it on, there's a bubble around it, if the volatility continues, maybe we'll have some realistic valuations coming up in small cap?
So I think corrections are part and parcel of markets. What I would say is that after a significant amount of rally that we have seen since March, April last year, there are pockets of irrational exuberance that we see within mid and small caps. And hence, over the last 6 months, I've been saying that it is time to be selective and be mindful to avoid those areas where we have excessive valuations, particularly in the context of illiquid stocks. Fortunately, we've been able to avoid that basket, and I think we continue to operate this way, which is why when the markets corrected in the correction of the last fortnight of a month or so, our funds relatively have actually held up quite better, relatively, i.e., versus the fall in the markets. And it's a sign that we have by and large avoided the areas where the irrational exuberance is. That's the starting point. Having said that, have we reached a point where the stocks are die-hard cheap and we can find bargains across the board? The answer is no. I think we are selectively nimbling around the stocks, mostly in the existing holdings where stocks have corrected. But the stocks that we still don't own, which might be the areas of irrational exuberance, are they cheap enough? My straight answer would be, as yet, no.
All right, so it's time to rebalance your portfolio. You know, we talk about a lot of thresholds that one should be maintaining in their portfolio as far as mid cap and small caps are concerned. You know, obviously, it also depends on the kind of financial plan you're following, your risk appetite, and the kind of strategy you've adopted for yourself. But then, but if one is seeing a good amount of profit in mid cap and small cap, is it the time to just allocate some part of it to large cap? Can we just focus on that part of our portfolio across market caps now?
Great question. So this is where, again, over the last 3 months, I've been saying to the investors that it's time for having a balanced portfolio across market caps. So if you look at as a house, the funds that we are recommending, of course, we are a manufacturer. We have funds that cater to every risk appetite and return objective. But given that I said that there are pockets of irrational exuberance within mid and small caps, and one has to be selective, to avoid those parts, those parts where there is irrational exuberance, it is better to replace them with large cap. Hence, the categories of funds which are particularly suited for times like these would be multi-cap funds, or for a conservative investor, a flexi-cap fund, because those can give the fund manager a bit of a leeway to rotate around the market caps based on the opportunities available, which is how I read the market at this point in time.
All right, Trideep, I think the time is up. I do have a lot of questions for you, but then unfortunately we'll have to just wrap it up with this. Thank you so much for being on the show and helping our viewers.
My pleasure.
Thanks. All right, so on that note, let's take a quick break, but then post that we'll be joined by Gautam Kalia, who will be taking up live viewer queries. So just in case you want to send across your questions, you can do that via WhatsApp number or email ID. And after this break, let's begin our live question answer session with Gautam Kalia.